where am I? Okay, so recently I have someone was introduced to me. One of my colleagues introduced me to his client who might interested to do stocks. So I reviewed the client stock portfolio. So since I already do the homework myself, I just showcase without the names, of course, just for education purpose. Okay, now. So this is the portfolio of this person's stocks, all in Singapore stocks, worth about nearly 400k. But I won't go through all, only the important one, mainly the bigger one. I just underline the bigger one. I got the small one, no point talking about it. Okay, so I'll talk about the bigger one. Okay, so let's talk about Singtel, which was quite big. So Singtel over the last 10 years, right? Okay, last 10 years, which is the white color here, the total return of Singtel, right, has been underperforming the STI. Okay, this is a total return. That means the performance is assuming dividends are reinvested. Okay, so it's everything in, and you find that the STI has been underperforming for a pretty long time. And the reason why this person had hold Singtel for so long is because the dividend has been great, right? It's currently more than 4%. Okay, and indicative moving forward is 4.7%. Okay, here. So so I did a research on why it's not been doing well. So if you look at Singtel's the revenue, you'll find that the revenue pre-COVID has been stagnant, and then post-COVID has been declining. So the declining revenue actually indicates that it's actually a dying company. Yeah, it's quite scary. It's a dying company. Now pre-COVID, right, the revenue has been stagnant. But a stagnant revenue is no good because after you take account inflation, right, it's also declining, right? So this explains why the stocks has not been performing. Okay? Yeah. Now next is UOL, right, which is a property developer. So I come up with many of this chart. For example, this is the net income of property developer. This is the revenue of the property developer for the last 10 years, and this is the free cash flow of property developer. Now all of them has something in common, which is there's no pattern. It's very irregular. Basically, there's no pattern. It's not going up, it's not going down, neither is it going sideways, it's all over the place. Okay, and this is typical of property developer. The business is like that one. Why? Because property developer, they don't have something to sell every day. They need to borrow lots of money from someone, from the creditors, and so there will be a huge inflow of cash flow when they borrow, and then they need to build properties, pay their subcon and their main con. So there will be an outflow, a big outflow, and then when they're ready to launch, then they sell, right, to their customers. This is the way how property developer works. And sometimes the market is bad, they actually withhold the selling. Right? I remember in COVID, right, a lot of property developers withhold their selling. They don't want to sell because they will be dumping right, into the market. So they hold. So if they hold, then there's no free cash flow coming in. So that's why the revenue, the free cash flow is all over the place. So there's nothing wrong with the company. But should you invest in such a company? No lah, of course not lah. Because there's this thing called irregularity discount. Okay. So irregular discount. So the white color is the share price of the property of UOL, and it has underperformed the STI, generally speaking. Okay, generally speaking. And I call this irregularity discount. That means because the company's free cash flow is irregular, therefore the market investor don't like the stock. So you end up having an underperforming stock. Okay. If the free cash flow has been predictable, you'll find that the share price will be overperforming, better than the rest of the market. Okay, so next. Okay, this is what I said. Let's look at SGX, right? So SGX was one of his holding. So I compare SGX with other stock exchange. namely New York Stock Exchange and London Stock Exchange. New York Stock Exchange is owned by this company called Intercontinental something, can't remember. Intercontinental Exchange. Right? So the white color, 10 years return, total return of SGX, white color, significantly underperform the other two exchanges. It underperform again. So what is the reason? There's a reason one. The reason is, okay, the reason is this. Okay, this is a 10 years annual free cash flow chart of the various of the three exchanges. I want to point to you this corner of this page here. Okay, ICE it refers to is the parent company of New York Stock Exchange, right? And LSEG is London Stock Exchange, and S68 is SGX. So you'll find that over the last 10 years, the free cash flow of SGX is increased on an annualized basis of about nearly 8% per year. But the rest, right, has been 15 to 25% per year of growth. So the reason why SGX stock price underperformed compared to the other two is because of lower growth, simply because of lower growth. Right? So if you have lower growth, then it's expected that your share price is going to reflect that fact. Okay, reflect the fact. Now after a while you realize that the fundamentals of the company, if it's a poor fundamentals, you will reflect in your share price. If the fundamental is good, eventually you will reflect on the share price. Eventually you will one. Okay, yeah, eventually you will. So don't hold shares just because you like the share, just because you're familiar. You're quite home buyers. Sometimes you're familiar with Singapore stock, so you hold it. Don't buy because somebody say that it's very good. You must buy because of good fundamentals. Basically it. There's no other reason. Don't buy also because of dividend. Okay, that is not a good reason, right? To hold. You buy, it must be good fundamentals. In fact, sometimes a company that pay high dividend, I question whether is it of good fundamental. Because imagine you're a CEO and you're paying such high dividend. That means you don't have any expansion project for the company. That means the CEO is sleeping. CEO is sleeping. Means the company don't need money. Of course, don't need money because if you have no expansion project. Sorry? The company is not, rather the CEO is not hungry. He is not ambitious, right? So he is not interested in growth expansion. So he have a lot of money coming in from the profit, right? So he don't know what to do, right? So he give out as dividend, Because you don't get a dividend, shareholders will ask, why are you keeping so much cash? They'll say, if you have no expansion project, give it to us. So high dividend yield company, right? Sometimes you must be careful. It could be because they have no expansion project. But sometimes there are exemptions. For example, like REITs, right? By law, they must give out at least 90% of their profit as dividend. Because it's by law, okay, so they have no choice. But if the REITs need to expand, then they will issue shares or they'll borrow more. Okay? That's how they expand. Okay. Next will be UMS Integration. Frankly speaking, I never heard of this company. But anyway, it was there. Okay. Precision. Yeah. Hey, you heard before? You heard before? You invested before?
No.
Oh, okay. I never heard before until apparently it was a different name, but I don't know. Okay.
Okay. There's some news on that.
Got news. Okay, I never heard that before. Anyway, okay, this is the chart of UMS, the white color one versus STI. Wow, look very good, Wow, it's like very good. This stock not bad, right? Not bad, right? Okay, so it's been a good run. I think it's done a good job. Okay, it's only the last few years. Okay, after COVID, a lot of things has changed. After COVID, right, the share price has been sideways for 4 years. So what is the reason? Okay, you look at this. The reason is because the free cash flow of the last 4 years has been declining. It's been going down. That means the company is dying. It's dying. Pre-COVID, generally speaking, although it's a bit messy, but it's generally up. Okay, generally speaking, the trend has been up, free cash flow. But the last 4 years is definitely on a downtrend. So that's why the share price is not going anywhere. But I'm quite surprised the share price have not plunged. maybe because a lot of old shareholders is still hoping that the good old days of will come back again. So when you invest, right, don't invest on hope lah. Okay, if you have invested in something already, whether you make money or not, but if you are going to invest, continue holding it because of hope, please don't hold it because of hope. So I'm sure no one wants to sell UMS because the old shareholders, they are sitting on a very good profit. Right? You look at this profit. Wow, if you have bought 10 years ago, you have made a huge profit, right? You have made a total return of 600%. Wow, that's good, right? Good deal, 600%. So, but I think a lot of people are not selling it because they hope that things will be like good old days. So don't hold an investment or buy an investment based on hope. Just make decisions based on fundamentals. So that's why sometimes my client, when I ask you all to sell something, if it's profitable, you will ask me, Wilfred, I think you go out some more. I want to hold on. That's hope. The reverse is true. Wilfred, I'm having a loss now. I don't want to cut loss now. I want to hold on and hope you will recover. Hope again. Then I'm very disappointed because you are gambling with money. Because hope is relating to luck, and luck is associated with gambling. So the way I manage portfolio is I don't gamble with your money. You want to gamble, you go to the casino called Marina Square. But your Singaporean have to pay a fee. The rest who are not Singaporeans is free of charge. You can just walk in, okay? So don't gamble with the money that I'm helping you to manage. Just you want to gamble, just do outside of my account, okay? Okay, ComfortDelGro. Okay, so ComfortDelGro, as you can see, the white color, which is the ComfortDelGro, has been underperforming for 10 years compared to STI. Now, why people are holding it, why this person is holding it, is because of dividend, right? It's 5.4. He tell me the dividend is very good, 5.4%. But if you look at total return, you factor in the price change, it's a loss. It's a major loss. So why is it a loss? Okay, same thing lah. The free cash flow after COVID, right, it's been declining. ComfortDelGro is a dying company also. It's a dying company. And I suspect that now they're competing based on price. See, when you book a cab, right, I always ask for 3 codes. Right? I'll use Grab to see how much. I'll see, then I'll go to maybe Gojek, correct, Gojek, and then I will see ComfortDelGro. Sometimes, most of the time now, ComfortDelGro is the cheapest one. Yeah, the cheapest one. So, quite interesting, right? And you know, Grab also will actually also include ComfortDelGro also, but the quotation is higher. So it looks like they're competing on price, desperate already. So as a customer, I'm using ComfortDelGro regularly, okay? But I'm not an investor. So you can see it's a dying. Okay. So again, fundamentals of the company can be is expressed through the stock's performance. Right? Good fundamentals result in good performance. Bad fundamentals result in bad performance. At least on a long-term basis. Okay, I say long-term basis because sometimes for no reason, right, a lousy stock do very well, and vice versa, a good stock do very poorly. That one no reason. That one is due to sentiment, emotion, news, and so on. But if you're talking about longer term means 3 years lah. I think 3 years is long enough to say it's long term. The stock price is reflects the fundamentals. Okay, so quiz. Now I got a quiz for you. I quiz my client, so I go and quiz you. Okay, so there are 4 stocks here. Which stock? This is the stock return price. This is the performance of the stock. There are 4 of them here. So which one you would like to invest? You like to invest the yellow, green, the yellow one, the red one, or the white one? Which one you like? All 4. All 4 is quite STI lah.
The white one
seem to be not bad lah. Not bad one. But okay, easier to ask you. Which one you will definitely don't want to invest? Easier that way lah. The lowest one, right? The lowest one, at least avoid. Because if I say white one, some people argue, wow, run up so much, maybe you're going to collapse. Maybe, I don't know, maybe, right? You always...
Which one if you're watching over it?
If I'm watching over it, maybe can.
White or red, okay.
Yeah. Okay, either white or red. Because we say history is not indicative of performance, but usually a lousy one, a lousy performer remain lousy moving forward. Normally it's like that one. Okay, there's some persistency in lousy company, generally speaking. Same as employee, right? If you have an employee that's lousy, likelihood you'll be lousy moving forward, right? Yeah, and a good one usually will be poached. Okay. Okay, so let me review to you what are the names of these stocks. They're all banking stocks. Yeah. Okay. Okay. OCBC and UOB, because this client of mine, he has OCBC and UOB, don't have DBS. Alamak. I don't know why DBS is often hated. Don't know why. Okay, generally speaking, when I do review, I find that people like OCBC, second UOB, and DBS usually. Huh?
When I first come to Singapore, I've got no paperwork, nothing, only DBS lets me open.
Let you open. Oh, good, right? But for investment, I don't know why people tend to gravitate towards OCBC. Yeah, there's a. Then I asked this guy, why is it OCB? Why not others? He said OCB more conservative. What conservative? Okay, so.
You're not gonna make money, right?
I don't know what I mean. Okay, anyway, so if you most people invest in banking stock in Singapore because of dividend. So OCB is giving 6% yield, and then the UOB is 5.6. I think DBS is around 4 to 5 or so, same. Okay, but in case you're thinking should buy DBS, I previously did some calculation. It's overvalued, and I did try to queue for DBS for you a few months ago. Cannot get the price. It's overvalued.
This is total return.
Total return again, a dividend reinvested.
You mean DBS overvalued?
Yeah. It is.
Wait, 1 or 2 years for the correction?
1
or 2 years.
Then buy more lah. Can. Yeah. Correction is always the time to buy more. Yeah, it's true. But there will be better stocks. I think. Yeah, definitely better because Singapore stocks really cannot make it. Anyway, beside the point, so JP Morgan, for example, give almost very little dividend, 1.8. As good as none. So if you do what I'm trying to, this chart will tell us a few lessons. One is that if you're focused on dividend, you'll miss out some very good stocks. And second thing is that don't buy because of very strange reason, like because it's more conservative. Invest because of fundamentals. So what is the difference in the fundamentals of these companies? So I compare JP Morgan, OCBC, and UOB, right? The two extremes. Okay, let's look at the diluted EPS means diluted earnings per share, which means the income, the profit of the company per share. Take for example, right? The diluted means that there's a possibility that there are more stocks going to be introduced into the market because of maybe stock options. Maybe the employee they are given stock options. So once they reach their options is exercise period, when they can exercise, right, you'll be converted to shares. So this will add more shares into the market, which is usually not good. Okay, because not good. So this one diluted means assuming everyone exercise. That means worst case scenario. Correct. So this is like worst case. Okay, so we're talking about worst case. So if you look at the EPS of these three companies, O39 is OCBC and U11 is UOB. Okay, you look at the growth for the past 10 years, right? You find that JP Morgan has been growing by 14% a year, whereas OCBC and UOB has been 6 to 7, less than 7% per year. So again, the growth of the firm, or rather the relatively poor fundamentals of these two banks, results in the poor performance of the stock price. The P ratio has barely changed. The P ratio of the OCBC and UOB has barely changed. This JP Morgan, right, has been 2% up. So the share price P ratio has barely moved. So the share price has moved primarily because of the growth of the earnings per share. Okay. Because JP Morgan's earnings per share has been growing better than the rest. Okay, more than 100% better. So the lessons to learn is the fundamentals of the fundamentals of a company always influence the stock price on long run. When fundamentals have changed, no such thing as hoping to recover, similar as gambling. Focus on dividend-paying stock results in non-optimal investment, especially when there's no tax advantage. So sometimes there are if there's no tax implication, right, then you can do whatever you want to optimize your investment. But of course, if there's tax implication, then you may be careful. You need to weigh pros and cons lah. So like for Lenny, you're full of tax implication, I know.
Have to wait 1 year. But it's not about fun. I don't really care as long as you perform.
As long as you got, yeah. Okay.
Correct tone, must give it the correct.
Don't care. Okay, okay. This tone is.
I'm trying to get into his presence.
Okay. So take for example, right? Assuming there's no tax implication, right? So we should always focus on total return, because you can actually simulate your own dividend, right? Let's say you have a profit of 20% already. You just sell 5 percentage point of it, then you let the remaining 15% compound, right? So you are creating your own dividend, right? When you do this, you just sell off. It's like, a bit leceh, you have to click, or you ask Wilfred, can you sell with her? Yeah, but it's only one step. If you do it once a year, it's only once a year exercise. No big deal, right? I'm not asking you to do it every month, right? So you can create your own dividend stream of dividend income by just selling stocks that, basically selling stocks, not selling the capital. Also, even if you to go on the dividend paying stocks, okay, you realize that when dividends are actually paid, the stock price actually falls exactly equivalent to the amount of dividend. So it's the same as selling the stock as well. There's no free lunch. It doesn't mean that the share price is now trading at $1 and it pay you 20 cents. You think the share price is $1? No, it drops by exactly 20 cents. Okay? So that's why we have this thing called ex-dividend date and before, right? Okay, this is the lesson. Of course, if you have tax implication, then the equation changes. Okay? The equation will change that if you sell this, then you're going to pay tax. Then maybe you should sell something you're making losses so that you can net off. Yeah, very messy though. Yeah. Okay.